This is Gene Arensberg, Got Gold Report, with our first ever video report. It is Sunday, April the 15th, 2012. Looking where we are, gold ended Friday near $1,658, up 1.1% for the calendar week. Silver limped out of the week at $31.48 on the cash market, down 1.2%. And the Amex Gold Bugs Index, or HUI, managed to edge about 2.7% higher. But that was after plunging 6.7% the prior week. As our good friend Rick Rule of Sprott Global points out in his April commentary, the market for smaller, less liquid, and more speculative miners and explorers has become a lot less expensive than they were prior to 2008 and, to a lesser extent, cheaper than early 2011 because so much of the liquidity has been sucked out of the market. The sources of liquidity that firehose-funded companies and supported their overvalued shares have reversed into powerful liquidity vacuums in an insidious negative feedback loop. Rick rightly points out that when small and large hedge funds and mutual funds are hit with redemptions, or what Rick terms disintermediation, and when those "I want out now" requests come in waves after the market has already sold down a lot, the managers of the funds have no choice but to sell their positions in the very same companies that made them look good in 2006 or 2007 or 2011. Now those positions are making them look very, very bad. They want what's left of their money back just to stop the pain. That's how they feel. Once again, we call attention to the fact that right now the CDNX is trading where it was in 2003 with $400 gold. These fund guys aren't dummies. I mean, they're not selling out of panic. They'd a whole lot rather be buying at these low prices than selling. But when the cash position is zero or negative and the calls keep coming in to liquidate, well, they become unintentional cannibals, eating their own. They end up chunking out the promising and the dreck with the same hand. So we end up with a HUI relative to gold chart that looks sick and wounded, just like that. And at some point in this process, the money managers who are reeling by then no longer have an option to protect their personal favorites or their largest positions or what they want to protect. They no longer have the flexibility to wait a little while for prices to improve. They have to sell. And at some point that means anything and everything that has any kind of bid at all. And so we end up with the bizarre circumstance of very large size, hundreds of thousands or millions of shares of a company hammering the bid in companies that scarcely even have a bid. And I think that's what we saw in Argus Metals this week. As vultures know, we were on the bid for Argus, and we ended up getting our fair share of the way too fast liquidation this week. Here's the volume candle chart for Argus in 1 hour increments for a closer look. And remember, all the bars are weighted by volume. And note that just in the very short time span of this chart, forget the big chart, but just in this chart, Argus has gone from a market cap of about $5.6 million to under $2 million. Why? Because there were still some sellers even when the buyers dried up. Mostly sellers and few buyers makes high volatility. Argus had already been buyer strike whipped, and here comes someone through Canaccord and CIBC flash dumping over 1 million shares in a few minutes. They, whoever they are, just righteously hammered the bid, or someone just gave up in despair and hit the red button. A big someone. The red button is the sell at market option. That's what we call it. And nobody should ever use a market order for 1 million shares. But they did. So we ended up getting some of it, adding to our stake as we disclosed in the charts that day. And this is the chart for Northern Tiger. And even though there's hardly a bid, what bid there is for these lotto ticket companies like Argus or Manson Creek or Northern Tiger, which is shown here, or some of the other cheapies with a chance we track and attempt to game, what bid there is today in this super weak market is from bargain hunting specialists, insiders, vulture speculators like us, and we're bidding a fraction at a time of the shares that we'll take or want, always willing to pull a bid. You know, we have partial bids in, and we're willing to pull those and set up even lower if the selling is strong enough, it comes in hot and heavy, because our job is not to be a market maker. Our job is to acquire the largest position we can at the very lowest price we can, given the maximum amount we have planned to risk for that company. That's while the accumulating is good, while the fun guys have to sell, and while panic rules, it's great to be a vulture. Perversely, falling stock prices stimulate the exact opposite response in retail gamers than it should. Falling prices ought to stimulate an urge to buy, shouldn't they? I mean, when you go to Costco or Sam's Club to buy something and you notice that the article you're there for is on sale, in fact, it's on a clearance rack, maybe by mistake, but there it is, marked down 50%, 60%, or 75%. Doesn't that stimulate you to buy? And aren't you more apt to buy two of that something instead of one if the price is a lot lower? I know I am. Psychology is different in the stock market. But does all this little guy selling make sense? Think about it for just a minute. Has gold sold off back to $450 the ounce like the CDNX is pricing it? No. Gold is about 4 times what the market for the little guys is pricing in if we use 2003 as our guidepost. How about silver? Has silver cratered back down to $5 an ounce to justify this vacuum of liquidity and lack of confidence by the market for the small junior miners and explorers? No. Silver is still consolidating its run up to near $50, and we think it's staging in a giant flag formation, biding its time, getting people used to this new silver price paradigm. Before the second most popular monetary metal resumes its march back to its former relationship with gold of 15 or 20 ounces of silver to 1 ounce of gold. In May of last year, the gold-silver ratio reached 31-year lows of 32 ounces of silver to 1 ounce of gold. Remember, we think that's a sign of things to come. That's if we're right about our view of silver resuming its popular respect as a monetary metal looking ahead. Right now, the gold-silver ratio is back up above 52 ounces to 1 ounce of gold. But unless the wheels really come off, we expect it to get back below that yellow line, or back below 46 ounces pretty soon. So, as we disclosed in the GDXJ chart, we re-entered as the market looked to us to be finding a bottom. It may or may not be, and we re-entered at 22.46. We've since moved our stop up to a no loss, 22.50, just for any of you who have not actually kept up with that chart. Our thinking is partly that it's a wedge retest. A great deal of liquidity has been sucked out of the junior mining shares market, causing disgusted and demoralized people to demand what's left of their funds from beaten up fund and portfolio managers who've had a terrible time with the little guy since February of 2011, and they're running out of shares to sell, I hope. At least that's the play. On this one, we'll absolutely rely on our stop and the usual 1 hour grace period. It's not just the little guys who have been pummeled. In fact, even the big boys of the mining biz have been cast overboard as people forgot all about why they wanted the miners in the first place. This is the Huey Gold Index. People have bought into the Fed's super easy money and multiple global central bank QE-driven rallies. So I don't know, I guess gold shares have become their bank to chase the big market, thanks to massive monetary easing by the Fed, the Bank of England, the Bank of Japan, the ECB, and so on. We got another 300 points or so of rally on the S&P 500 because of all of that central bank printing. So people sold their gold shares and some or all of their gold to chase Apple and some of the bank stocks. But they either don't realize or have already forgotten that all that government stimulus is either borrowed or newly printed or both. And all they see is things have got to be better, don't they? Why, look at the stock market. It's going up. Yes, equities are higher priced, but largely because the capital is being forced into equities in a hunt for yield in an artificially manipulated negative interest rate environment, while price inflation is camouflaged in government-managed statistics. I forget who said it, but it's like being in a house of mirrors. I believe it was Jim Grant that said that everything we see is a distortion. The bitter truth is, friends and fellow vultures, without all that Fed and central bank intervention and manipulation, the big markets would have failed faster than a North Korean rocket test. Right now, quite a few of the promising junior explorers we track have been put on the clearance rack at stupid cheap or ridiculous cheap prices, and bargain-loving vultures ought to be there, with bid ladders catching their fair share of the goodies being thrown overboard by the panicked and the fearful. But for some reason, that isn't the way it is in the stock market in general, and in the small junior explorers in particular. Up to a point. No, for some reason, the markets that we trade are populated with not speculators, but with, quote, investors, unquote, who neither understand the cyclical process of positive or negative liquidity underway, nor have the courage of their convictions to commit their precious resources to buy when the buying is great. Instead, they panic, selling at the precise time they should be taking advantage of the tremendous markdowns a negative liquidity environment provides for them, even when the little guys are trading as though gold is heading back to $4.50 the ounce or less. And so finally, friends and fellow vultures, as we said in a recent video, which you can find on the free Public Got Gold Report blog, we've decided to sell some gold in order to take advantage of this nasty outflow of liquidity from the junior exploration sector. We're doing so because of our strong conviction that, as our friend Rick Rule says so well, the cure for low prices is low prices, and Rick has tremendous faith that people will respond in fear or panic only so long before that condition is completely and totally replaced by its opposite, tremendous greed once again. Isn't that what our gold is there for? To preserve our purchasing power until we see great opportunity to put those resources to work for us. We certainly think so, but everyone can and should decide for themselves if they agree with that idea. They can decide if they have the risk tolerance for it or not, and if they have the appetite for it. And above all, whether or not they really are vulture speculators, or if they just enjoy reading about them once in a while. Moving to the subscriber pages, we've updated all the technical charts and continue to make frequent comments directly in the Vulture Bargain charts. Until next time, thanks for watching, vultures, and thanks very much for honoring us with your business. We still have a lot to learn using this video format, but like an old dog learning a new trick, we aim to get better at it as we get some practice. Bye for now.